Hey everyone, it's Daniel here from InfoS. Hope you're all doing well. So let's talk about a couple of things here. We heard about Credit Suisse going bust. We heard that UBS basically buying them out for a very, very discounted price, right? All these bank contagion effects affecting especially more the European side of things, right? Started in the US, moved into the European side. The ECB hiked interest rates by 50 basis points and said that they're going to be data dependent. They're going to look forward to see how data comes out and how these, banking the banking sector plays out in the coming months, and they didn't really give a particular, direction, leaving it kind of open that sure they could pause or they could hike. And then on top of that, we have the Federal Reserve coming out this week, Wednesday, to discuss about their decisions when it comes to the interest rate decision and also forward guidance. It's going to be very important too, because in the projections that the Fed has with in terms of rates and in terms of growth, you're going to see where the Fed anticipates the federal funds rate, where that level is going to be in the coming months. And we know prior to all this bank issue that we've been seeing, we've heard from the Fed that they wanted to move the terminal rate higher and higher, and they wanted to continue to be aggressive when it comes to hiking rates, and even mention about faster rates like the 50 basis point rate hike may be coming in. But then afterwards, when this banking crisis happened, all of a sudden cold water got poured on that idea. We saw 2-year yields completely jump up, right? Projections of a rate cut expected to come very, very soon or sometime in this year, not only in the US but around the world as well, like Canada and Europe and so on. So what does this mean going forward, right? And on top of that, with all of that, you have the Fed coming out, putting in liquidity in the markets. 4 months of QT was basically reversed in just one day with the addition of more money, more liquidity in the system. And just yesterday, the global central banks coordinated that they will need to inject more liquidity to short-term liquidity to create more supply of US dollars so that the banking system globally doesn't break. So you're getting this liquidity injection. Is this QE? Is this not QE? What is it? Is it like 2019 where the Fed said this is QE but not QE, right? And so I would argue that it's not really QE, right? What is QE, first of all? QE stands for quantitative easing. And in quantitative easing, it's a methodology, it's a tool in the Fed's toolkit or other central banks' toolkit when it comes to printing money, buying bonds to lower the yields and create easing conditions in the financial conditions, creating easing conditions for the banks so they can lend out more money, and that money and flow of money could circle around the economy. People will borrow more, spend more, and the economy starts running kind of smoothly, right? Or like we saw, especially in the bottom of 2020, March of 2020, injection of QE, and the result was we saw stock market do a V-shaped recovery. And we saw in 2021 more printing of money, trillions of dollars in the system, and you saw the stock market, real estate prices, and everything rally quite aggressively. So this pumping of liquidity that we are seeing from the Fed, the pumping of money to save the banks, and the fact that also JP Morgan came out that $2 trillion are being injected in the economy, does that mean that this is good for stocks? Should we see stocks moving up here? Should we see a rally in stocks? So do we go long risk assets? Right? And obviously, do we go long Bitcoin and crypto and gold and all of that? We've been seeing that Bitcoin and gold have been rallying So is this QE? And I would say not exactly, right? There is an injection of liquidity, but this injection is more focused on the shorter duration, shorter term funding, versus QE is more focused on the long duration, the long dated bonds. So I wouldn't really call it QE. Now, in order, in my opinion, for equities and for risk on environment or risk assets to rally, we need to see the real QE come in. So does that mean that this QE stance is just a fluff and it doesn't mean much and we could see things turn around? Well, that is going to be dependent on what Jerome Powell says this Wednesday. Is he going to pause? Is he going to cut rates? What is he going to do? You have one bank projecting that he's going to do a 25 basis point cut. Another bank says he's going to do a 25 basis point hike and then pause. Another one says that unchanged, no rate hikes, right? And then pause from there. So, and if he does pause, what does that mean going forward? Or is the Fed going to do just like what the ECB has done, a 50 basis point rate hike, and then just kind of pause and wait from there and see and be data dependent? Could we see the Fed do the same thing? And I think this meeting is going to be really, really, really critical, because if there are signs that he is cutting and he is pumping real QE, real money in the system, then sure, this will basically inflate risk assets and stocks and Bitcoin to the moon and all of that, and you'll see the equity markets really, really like that and rally. But if it's not, and there's no mention of QE and they're continuing with QT, they haven't done QT, they haven't stopped, right? And they continue with QT and they continue to say that, hey, you know, we're going to assess the situation. We may pause here. We're going to assess the situation, see if anything breaks in a month or so. If not, nothing breaks, we'll continue the hike. Or the other scenario is we hike and we do the 25 basis point rate hike, and we do exactly what the ECB says, that, hey, we still need to fight inflation. Inflation is still our target. We need to bring it down, and we need to continue to be data dependent. If inflation is not coming down, then sure, we will continue with our hikes in the next meeting, especially if nothing breaks. So if nothing's breaking and the unemployment rate is still at all-time lows and inflation's high, and the banking sector is fine because they injected the short-term liquidity in the markets, then it gives them a reason to continue on with the rate hikes. I don't see any reason why they would stop, right? And it all depends, again, on the data. And don't forget also that the Fed has a dual mandate. What's the dual mandate? The dual mandate is the Fed is focused on two things: bringing inflation down and making sure unemployment rates are at safe levels, right? They're at a fair area. They're at the maximum, the economy is at maximum employment, and that the unemployment rate is not skyrocketing. And that's what we're seeing. We're seeing that the unemployment rate hasn't skyrocketed. Yeah, we saw the initial break in the banking sector that created some contagion effect, but we have yet to see the continuous effect, which probably is going to take some time, or maybe something we will see later. We have yet to see the true effects of what all these regional banks, the issues with Credit Suisse and so on, and also the issues with all the rate hikes that the central banks have been doing. We have yet to see the true pain. And if the true pain comes in, and then we see that unemployment rate skyrocket, then sure, very likely you're going to see that real pause. And forget about the pause, you're going to probably see that rate cut, right? So now, again, there's also some comments and some people that argue that, hey, if you look at in 2019 when the Fed did QE, not QE, Then afterwards, a couple months later, the stock market sold off because of this COVID issue, even though that they were somewhat easing and cutting rates there. And on top of that, in 2008, we saw the same thing, cutting of rates and easing, yet the stock market still sold off. Same thing in 2000. You know, history may not repeat itself, but it often rhymes, right? Famous quote by Mark Twain. And so if that's the case, then maybe that's what might happen, where you might get this scenario where more failures does cause that unemployment rate to skyrocket. So one of the mandates for the Fed plus the other mandate of inflation coming down. So right now, here's the unemployment rate at a very good level. Inflation's here, it's too hot. Well, if something breaks, then you'll have the reverse skyrocket of unemployment rate, and most likely inflation will come down. Thus comes then the QE and the cut of rates, which then should stabilize the markets and bring risk assets higher again. So again, you know, it will all be dependent how the Fed comes out on Wednesday. If the Fed completely, does a 180 and starts doing QE now and cutting rates now, well, then the next question is, what happens to inflation? You've got really low records of unemployment rate. Inflation's here at 6%. Does that mean inflation shoots up higher, which is likely? And if that's the case, is the Fed going to attack that, or is the Fed going to let it go? Which means that there might be even bigger problems, especially in terms of the US dollar, the world reserve currency, if the US and the world has to live with high inflation and very elevated inflation, and not only elevated inflation but runaway inflation, and something that they cannot control, then the Fed has completely failed. And there probably would be no reason to have the Fed at that time, because they basically failed at their job. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, the bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.